Buying your first rental property. This is the full guide. In this guide, we're going to discuss 6 important keys that will help you evaluate, manage, and purchase a single family home. Now, if you don't qualify for a single family home, this video will help you learn how to qualify without those particular things. No matter who you are or where you are or what city you're in, these particular steps will help you do just that. Now, what are some things that you don't have that you need to have to help you qualify to purchase a single family home? Well, number one, you need credit. Credit is vital. There's no way you can purchase a single family home without credit, or even if your credit is very low. The second thing you need is taxes. You need 2 years tax returns to get approved for a conventional loan. If you don't have tax returns or you don't have income on your tax returns that's enough that will help you qualify, then you won't qualify. And the third thing you need to have is money. Now, this is the single biggest issue that people have when purchasing real estate. They don't have enough money to purchase the real estate. They don't have enough money for the deposit. Also, they're priced out of their particular neighborhoods. For instance, I'm in Brooklyn. Homes in this particular neighborhood cost anywhere from $600,000 to $1 million. Most people can't afford that. So before we get into it, I just want to let you know there's a PDF below in the description box. It's a real estate starter kit that will teach you a step-by-step process on how to purchase a single family home for a profit. You don't want to miss out. It's in the description box below. Just click the link. Also, at the end of this video, I'm going to give you a free bonus on how you can invest in real estate at a faster pace. There's one particular proven strategy that helps you do just that. The number one thing you got to realize is that you want to make a profit when buying your homes. If you don't make a profit when you buy your homes, then there's no purpose of you to invest in real estate. I mean, we're not doing this for my health. As my father would say, you think money grows on trees? It doesn't. You got to go out there, you got to find a deal that's profitable. It's called sweat equity. What does this mean? You got to find a house that you can renovate to be able to put it back on the market to resell or to refinance. This is the bottom line. So in this part here, I'm going to show you the formula that you're going to need in order to be able to make a profit. And the main thing is that people look for when purchasing a single family house, a duplex, a 4-family house, a multi-unit house is what they call the profit rule. And this profit rule is 25% on average. Now, if you get a higher profit than that, then that's more money for you. But 25% is the amount of money that you got to go for when looking for any particular house. So I'll do some quick numbers. Hopefully you can stay with me. But let's say you got a house and the market value for that house is $200,000. What's 25% of $200,000? It is $50,000. That means that the profit that you're going to make by buying this house has to be $50,000. Now, how do you get this number of $200,000? Well, I have another PDF below that shows you how to do a comparable analysis for any house you're looking for or for whatever particular neighborhood you're in. So what you do is you take that $50,000 and now you know that's the profit margin you're going to make on any particular house that's in this particular neighborhood that's a single family house. Now, you have to subtract the rehab from that particular amount. Now, let's say the rehab amount is another $50,000. So you have your profit of $50,000, your rehab is at $50,000. So ultimately, you would pay $100,000 for this house. Simple math. Most times, people do not do this simple math, and they end up buying a house that they can't afford, that's overpriced, and it has no equity. Equity is the name of the game. Number 2. How to buy a house with no money. Now, this is the single biggest issue that all investors have when starting off. They don't have enough money for the deposit amount. I mean, $20,000 is a lot of money to put down as a deposit for a house. Now, the question is, how do you afford to purchase a house when that particular neighborhood is priced out for you and for folks like you? Well, what you got to do is, ultimately, you have to raise the money. Now, there are two ways to qualify for a single family house as an investment. You have FHA, where you can put down 3.5%. Most likely, you won't get approved for FHA because the house may need too much work unless you do the 201 loan, which I don't think is a good option because the 201 loan takes a very long time to get approved. So most sellers and brokers don't like going down that route with a buyer. So what you got to do is you have to raise the money from a partner. And the best way to do this is to speak to your family and friends where they can give you money and you can pull together some of your money and you all can come together to put down a deposit. For example, in the last house that I gave you of $100,000, 20% of that would be 20 grand. Let's say your closing cost fees are 5 grand. And so what that will allow you to do is to not have this idea that you have to work for multiple years to be able to generate $20,000. No, you go out and talk to people that are in real estate that has money, that's willing to give you the money that you can use as a deposit for your house. Now, would you have to share with them the profits of the profits when you sell the house? Yes, that's the name of the game. So you have to be able to give them at least 25% of the profits or 50% of the profits. The way it works is that the person with the money gives you the money, and then you, being the person that identified the deal, now that you know what's a good deal and what's not a good deal, you can manage the whole process of rehabbing that house, and then you can find a broker to sell the house. This is how it's done. They give you the money, you do the management of that house, and then you guys can split the profits 50-50, or you get 75, he gets 25, or she gets 25, or whatever the case may be. You can work out the numbers, but ultimately that's how it's done. Number 3, how to buy a house with low credit. Well, this is another huge hurdle that everybody has to get through when they're purchasing a house. See, when you talk to the bank, the first thing they're going to look at is your credit. So if your credit is low, or if you do not have credit, you got to do the same thing that you did when raising money. You have to find a partner that's willing to partner with you as what they call a credit partner. Now, how does this work? Well, when you are about to purchase a house, you're going to have to form an LLC. And in this LLC, which is a limited liability corporation, you would have to give the credit partner at least 25% of the equity in that house. Sometimes you can give them as low as 15%, but some banks or most banks require that you give them 25%, which ain't bad, because if you do not pay the mortgage back on a monthly basis, that means that the bank is going to come after not only you, but the credit partner. Now, the credit partner is going to be on the hook for a loan of $100,000 or $200,000 or whatever the loan amount is. Now, for 25%, that's really good for the credit partner. Now, the credit partner may ask for more, but I think 25% is more than enough. So ultimately, you got to get a credit partner who has a great credit score above 680. Even 700 or 740 or 800 credit score would be more advantageous for you because you can get better terms with the bank. Just something to think about. Number 4, how to get bank financing. This is the 2 biggest critical things you got to understand. Well, number 1, you got to understand some basic terms here in order to understand how to get bank finance and how to qualify for bank financing, right? So you have conventional loans and you have investment loans. In this video, I'm just going to explain investment loans. Investment loans, there are pretty much 2 types of investment loans. Now, the investment loan option number 1 is it's a no-doc loan. What is a no-doc loan? It means that you don't have to show W-2s or tax returns or pay stubs. It also requires that you put down 20% of the purchase price. Now, you're going to raise that from your partner. There's also a requirement that you got to have a credit score of 660 or better. Now, you can also get that from your credit partner. Now, the 4th thing with this is that it's an interest-only loan for the first year. Also, there's no prepayment penalty. Now, what is interest only? It means that when you pay back the bank on a monthly basis, let's say you pay the bank back $1,000 a month. That money goes towards the interest of the loan, not towards the principal of the loan. So let's say if you owe the bank $100,000. At the end of this loan, you're going to owe the bank $100,000. You're not going to owe the bank $90,000 or $88,000 at the end of the year. Why? Because it's an interest-only loan. Also, going back to the prepaid penalty, you don't pay any prepaid penalties if you pay back that loan within 12 months. The bank doesn't care. Now, is this a good loan or a bad loan? I mean, I think it's just a loan you take out if you need to take it out, and your reserves are really high, and this is the only option you have. But the second option under the investment loan, I like a lot. It's still the same thing in terms of no doc loan, right? No taxes, no pay stubs, no W-2s. The second thing is you still need to put down 20% of the purchase price. And then the third thing is you got to have a credit score of 680 or better. Okay? And the fourth thing is that, now here's where it gets really interesting. You can take out a 30-year loan with a little bit higher of an interest rate. The interest rate for this 30-year loan is going to be 7.5% currently, but the loans or the interest rates that are currently out there are about 5.5%. Now, it is a little bit higher, but you have to pay to play, because if you could get approved for a conventional loan, you wouldn't have to pay an extra 2 percentage points higher than a typical loan amount. So think about this as you make your decision. My suggestion would be to you is that if you can't qualify for a conventional loan, which is the first option, the first real option you should try to get, because instead of you putting down that 20%, you can put down 3.5%, which is a lower deposit amount for yourself. However, if you don't qualify, which is the reason why you're here, then you would go with that second option under the investment loan. Now, because over 30 years, you can have cash flow coming back, the interest rate isn't that high, and it's okay. Number 5, finding a great deal. Well, the formula that I talked about earlier in terms of the numbers, you have to know your numbers before you start looking at a deal. Now, how do you find out what your numbers are? Well, you take the market value, you subtract your profit, you subtract the rehab, you subtract the closing cost fees, and the balance that's left over is the offer that you submit. Now, let's say this market value is $200,000, which again, I have a PDF below that explains to you the market value, or how to get the market value for a particular house in a particular neighborhood. Now, also don't forget, I have a free PDF below called the Real Estate Starter Kit, which gives you a free step-by-step guide on how to process or how to invest in a single family home for a profit. Now, it is $47. However, there are a lot of templates in this PDF that's going to show you how to submit an offer. It's going to show you the rehab budget process. It's a 20-step rehab process that you got to have. Also, you're going to get the free comparable market research and a host of other things for this PDF. Just click the link below. As we continue on here, finding a great deal allows you the opportunity to go out there and look and hustle and hunt. So when you're out there looking for great deals, you got to know what you're looking at. And the only way to really know what you're looking at is to understand this formula. This formula is your lifeline to becoming a really successful real estate investor. So you're always looking for discounted homes, homes that need a bargain, homes that are below market value. If the homes are not like this, then do not invest in those types of homes. Never buy a home that's at market value unless you want to live in a house. Unless you just don't care, you make good income, and you're like, I just want to live in a house. I don't mind paying a rent of $3,000 a month or $2,500 a month or whatever the monthly amount is, you do that. But if you're trying to make an investment into a single family house, then you have to buy homes that are below market value. Right? This is the way to think about buying homes. So the way to really identify homes that are below market value is you have to go on Zillow, Redfin, Craigslist, CoStar, Shark Tank, not Shark Tank, Property Shark, Property Shark. And here are the 5 good sources to look at when looking for homes. And also, obviously, people that's in the industry that's buying and selling homes. You want to see what they're doing, what they're working on, and constantly stay in contact with these people. And also get on lists where wholesalers are sending out their deals every single month or every single week. Get on that list and be ready to rock and roll. However, before you start looking for deals, please get pre-qualified through your investment loan banker before you even start looking at homes. Because why? You're going to waste a lot of time, energy, and money looking for deals with no pre-qualification letter. So don't do that. The last thing is, should you do the BRRRR method? And what is the BRRRR method? It's buy, renovate, rent, refinance, and repeat. Should you do this method? Well, for me, it really don't make sense to do this method if your cash flows are really high, right? Because you can use that extra cash flow to pay down the debt in a faster pace. So how do you know what the cash flow or what's a good cash flow for a house? Well, let's say if the mortgage amount is $2,000 a month, includes your taxes and insurance, and you're making $2,000 of cash flow. On top of that $2,000, that's a good amount of cash flow. I would use that money to pay down the mortgage. However, if your cash flow isn't that high, then I would consider to refinance, get your money back out, and do it all over again. It all determines on the cash flow, and this also goes into my last point: should you hold or sell a house? Now, it all depends on the cash flow and the equity of that house. Now, the equity amount should be at least 25% or more, but let's say the property has increased in equity in the last 6 months since you were renovating the house, or within that year of renovating the house by 20% or 30%, maybe it's a good time to sell the house, take that equity, and do it all over again. Or you keep the house and you are able to just have the equity increase. Also, another determinant, which I said earlier, is that cash flow. You have high equity in the house, plus you have a good cash flow in the house, then you also keep the house as well. So this is the only two metrics in which and whereby I would keep a house. But if the cash flow isn't that high and the equity is only at 25%, maybe you just refinance and take that money and do the same exact formula for another house. Here's how it's to be done. Again, there we go, folks. Please don't forget to click the PDF below. It's a real estate starter kit, and it explains to you how to buy a single family house for a profit as a beginner. You get 3 bonus templates to go along with that offer. By the way, until the next time, check out my other video here.